Welcome back to the Everything Property Podcast. Now, how would you go if you needed to start again? Not just losing all your money that you had, your parents lost their jobs, you lost your family home, and you pretty much had to start from scratch. How do you think you'd be able to handle it? Well, today's guest has done exactly that, and since founding his own mortgage broking business in 2014, has ranked in the top 100 brokers nationally. Welcome to the podcast, Redom Syed.
Hey, pleasure to be here, David.
No problems, man. Thanks for jumping on. You've also got your own podcast, but talking a little bit beforehand, you told me you're not too much of a fan of listening to them back. Obviously, the listeners do listen to podcasts if they're listening to this, so make sure you jump on and you have a look at Redom's one too. Look, what I've brought you on today, we're talking about increasing your borrowing capacity.
Mm-hmm.
I see you very active on the socials, preaching and sharing a lot of information around this. For the audience, what we're trying to do is be able to educate them into ways and techniques that if they've went for a loan or if they're going to go for a loan, how to equip themselves with the best possible chance of borrowing the most amount of money as possible. So I know quite well because I've done some research and some listening and stuff on your background and how you started. But let's just jump in and give us a quick little high-level breakdown of that story I opened up with and when you started to getting to where you are now.
Yeah, sure. So to clarify, I don't think I lost everything so much, but I was a teenager at the time. So mortgage rates went up, both my parents lost their jobs, and we essentially had to sell everything as a result. So that happened to me when I don't remember the exact year, but the process sort of began when I was around 15. So that sort of experience can really shape the direction of your life, particularly for a young boy at that point in time. So, I use that as like an experience to help me really focus and narrow down on exactly what I wanted. So clarity came to mind there when I saw my parents really, really stressed out by money all the time. And I was like, look, how can I help? And, my parents are migrants, so we kind of get inbuilt within us that our parents have made this big life choice to change their entire community. And drop everything, come to Australia. So there's like this big sense of responsibility that I had. And like they were struggling and that's just the truth of it. They were stressed, they were struggling. This is not a pleasant experience to go through. And I was just watching this being like, look, you've given me every opportunity and I understand Australia a little bit better than you do. It's just their education levels and integrating was a little bit more difficult for them. Mm-hmm. So I used it as a chance to just propel myself and really focus in on what I wanted. And I wanted to do really well for myself, whatever I chose. So that was really a pivotal couple years in my life. And really it's just gone on from leaps and bounds from there.
What would you say, what made you pick mortgage broking? You were ducks to the school, performing really well, doing some extracurricular maths.
Yep.
What made you choose mortgage broking? You had everything in the world. Was there something you saw, read? Was there someone that influenced you or anything like that? Or
yeah, a little bit. So between that, I worked as an economist at Treasury. So that's very much a nerdy academic type career. A lot of people that are economists and working at that building or at the RBA would have very academic type backgrounds. And that's what I was working towards. It's kind of what I knew, and it's quite common in my culture to be like, let's study. And that's kind of what I was doing. But then, I got a property bug. That's what I'd call it. Like, I just love talking property. I love thinking about property. I began property investing. I was like addicted to it. I was on it all the time. Not on podcast formats. I don't think there were many podcasts back then, but, I was like learning about it in every way possible. And that's kind of how I shifted into mortgage broking because it gave me the opportunity to talk property all day, every day. And that's what I've been doing for, nearly a decade now.
Crazy. Some of us start podcasts, some of us start mortgage broking businesses. Okay, perfect. And then, so you start in 2014 as a mortgage broker. Had you, when you're working at Treasury, are you building and buying a property portfolio? Are you starting it then, or are you starting it as a mortgage broker? How did that sort of, where did your property journey start, like in terms of buying property, and how did that correlate in line with your starting your business?
Yeah, so I started investing in 2013, so a decade ago now. Began investing. I bought just high yield sort of assets. There was this scheme at the time called NRAS, which just allowed you to inflate your rental returns a little bit. And I bought a few of those while I was at Treasury. So that was my initial property investing experience. At the time, it was very easy for investors to get credit. You could extrapolate your money a lot.
Pre-2018 and stuff.
Yeah, exactly. So, I bought really as much as I could. I wasn't on a high income then or anything like that. I was a grad, a couple of years out from being a grad in the public service, doing well enough for myself at that age, enough to save a little bit and, invest those savings into property.
So what type of assets you're buying in those early days?
At the time, you had to buy brand new properties to access the scheme. So I bought a few brand new properties. 2013, 2014 was a big year in the Sydney property market. It's testing my knowledge a bit, but it was a big year because when I first purchased something, I bought something that was like pretty much ready to move into, but wasn't quite done. So it wasn't titled. It was ready to move in after 3 months. But by the time I valued up, it was like worth 100 grand more than I paid for it because the market was making step changes in 2013, 2014. So I essentially funded one property with one deposit and it kind of bought me three at the time.
And you're buying these in Sydney?
So one was in Sydney.
Yep.
2 were in Brisbane.
Okay.
Yes.
Okay, so you've got 3 under your 3? 4?
Yeah.
3 under your belt,
yep.
And then you start Confidence Finance?
I did, yes.
Okay.
Yeah, so.
With only 3-4 properties under your belt,
yep.
You start that in 2014. My records show, some young performer awards, and then you're moving into from 2017. You posted 36 mil worth of loans in 2015, second year of business, not too bad. And then 2017 and onwards, you started to post some bigger figures. You start Confidence Finance. That's been going since 2014. As business is picking up, you're buying more properties?
Yes, so I would have taken a break from investing for a couple of years then. Serviceability is tricky when you start a new business. And then once I could purchase again, I did. That's kind of a general investing philosophy I have. When I can purchase, something somewhere is doing well, it's up to me to go and find it. So I obviously change my risk frameworks around a little bit when, markets are falling aggressively or when there's like a short-term down cycle that's occurred. But in general, when I'm ready to buy, I do look for opportunities, and cash is something that I don't like having. So it's really the opposite mindset that a lot of people have. I don't like holding cash. When I hold cash, I feel a little bit icky. Like that just means I have access to an opportunity that I'm not taking. It's up to me to go find it. So I turn my mindset on to be like, it's time to start looking for something because I'm ready to go. So where can I find the best allocation of this capital and borrowing power that I have at this moment in time? Where can I find the right opportunity? That's the general mindset I always have at the moment. Okay,
and you've built out to 25 mil portfolio worth?
Yeah, I don't like ballpark. Yeah, so some of our projects are in development stage. So whether I hold on to that, whether I sell part of it, I don't actually know.
What is that broken down into, like investment properties that you own versus development projects?
Good question. It's probably 10 is buy and hold sort of stuff.
Yep.
I include my PPR in that, so maybe that's not fair analysis. I don't know what people do here, but maybe 10 is general sort of buy and hold sort of stuff, and the rest will be development that floats in and out. That's roughly where it's at.
Okay, perfect. So
there's probably 15 million
projects. You dabble in a bit of development. I won't go too deep into it because I'll have you here all day talking about it. One of my definitely one of my strong points that I like talking about. But look, let's jump into it now that we sort of know who you are and where you've built to. Increasing your borrowing capacity. So by the end of this episode, I want whoever's listened to this to come away with 5, 6, 7 things that they know that they can do or that they can work towards doing, so that when they go to the bank, they can borrow as much money as possible to buy their PPR, their investments, that kind of stuff. So I guess what would you say, let's start off, what would you say is number one or the first thing to look at in terms of what's weighing heavy on reducing your borrowing capacity?
Yeah, so I'd dial it up one level and explain to people how do actually banks work out your borrowing capacity. Because I think once you understand that, it can make the frameworks for increasing it a little bit clearer. So it's really, really simple. It's just banks all run a budget on you to work out your borrowing capacity. They get your income, they subtract your expenses. Whatever's left over you have every month, that's generally what you have available to make mortgage payments. So There's obviously nuances within that, particularly on the income and expense side that we'll run through now. But that's how banks work out how much you can borrow. So very, very simple. If you have a lot of surplus cash flow every month, it probably means that you have borrowing capacity available to you. As of right now, borrowing capacity is probably the biggest challenge in the marketplace for investors and home buyers across Sydney, definitely, and probably the country. Big reductions in borrowing power have occurred over the past 18 months, roughly 30-40%, even more for investors. So there's been a big drag on borrowing capacity, and now investors in particular are looking for ways to actually get money from banks, and it is getting more and more challenging to do that. So the key thing to note here is in that equation, income less expenses is what works. You can always increase your income. That is a truth. There is no limit to your income increase. There is a limit to your expense decreases. Banks have a minimum that they'll take, first of all, and two,
do you know any of those off the top of the head? Sorry to put you on the spot, but would you know
Numbers
what
go?
like? Yeah, give me. So for like, let's break it up. So for like a single person in their mid-20s, what would be? Does it matter male or female?
No, they don't use gender.
Perfect.
In HEM.
Thank God. All right. So, what would a single person in their 20s? What would be the minimum amount that the bank would say that they would spend like a month?
Yeah. So this scales depending on income. So if you're on a really low income, let's just say you're on 30-40 grand, not earning, you're a grad or something like that.
Yep.
The bank will probably take around $1,300 a month.
Okay.
But for most incomes. So most income levels, so once you get past 50, 60K, you're looking at around $2,300 as the general HEM level for a single income between, 100 and, I don't have this on the top of my head, but between, 100 and 200,000.
Okay.
And then it scales up. So as your income rises, HEM starts scaling up too. That's pretty standard. If you make more money, you're going to start spending more money. So HEM, the measure that the banks use to calculate your expenses is a function of basic living expenses plus, the top quarter of like discretionary expenses. So someone who makes more money spends more on discretionary things. So that's why HEM scales up as your income rises.
Makes sense.
And then for a couple, let's go to the other end of the spectrum.
Yep.
And, a couple doing really well in Sydney, Sydney, Melbourne, anywhere in Australia, making say 350 grand between them, doing really, really well for themselves. Yep. That HEM level is around 5,300 per month, and it stops rising really after that sort of income level.
Okay, and what about like say if they were both out of uni or new grads and it was collected income of 120 to 150 or 180? Would that slide back down then?
Yeah, that would slide. Yeah, it would slide way back down to roughly 3.5.
Okay,
that's just ballpark on the top of my head there. That's
all
kind of the expenses that they use.
Perfect. So now that we've got that sort of underway, general rules of thumb. So I can't, no matter if I'm absolutely frivolous and I'm eating bread and air all week, the bank will take that as a minimum, regardless.
Don't bother. Yeah, like it's a bit of a change actually, because I have watched little TikToks and other brokers talk about this, but don't bother. There's not much point to spending below this if you're purely thinking about borrowing capacity. Obviously, if you're spending less than this and you're going to save more money, you're going to do well financially, the faster your deposits are created, right? So that helps, but you don't actually boost your borrowing power by spending zero. Banks will use this minimum on you either which way. So if that's your goal here, don't bother, spending well below it.
Fair. Yeah. It would help you to save your deposit a little bit quicker, but I mean, in terms of serviceability. All right, so if that's fair, in terms of increasing your borrowing capacity, you did touch on the first one would be increasing your income, which is sort of the other end to look at it.
Yes.
Increasing your income, second job, stuff like that, worth people's time, yes or no?
For sure. So giving someone a quick little number to use. It's my last LinkedIn post, so I remember this because I prepared it yesterday. So if you increase your income by $10,000 a year, you'll get a multiple increase of about 7.5 times your income.
Really?
So that is an income increase. So that's different to your first, $50,000 worth of income.
It's not times that by 7.5. It's if you go from 50 to 60.
Exactly. Yes. So if you don't move, and there's caveats to this as well. If you don't move between those HEM bands that I just talked about. So, if you stay within that same band on expenses and your expenses aren't magically rising because a bank, uplifts your expense level, they have bands. So, if you stay within the same band, then your income increase is about 7.5 times. So, if you're on a really high income, it works for this equation. So if you're on a really high income couple, you'll probably get a 7.5 times multiple, maybe a little bit less because you get taxed a bit, but that's just a general rule of thumb. 7.5 times you can get by increasing your income.
$10,000.
$10,000, yes.
Wow. Interesting. I didn't know that.
Variable income, you just touched on that. So, overtime, commissions, bonuses, a lot of lenders, pretty much all lenders, except non-bank lenders, they shade that income at 80% of what you actually earn. So,
for bonuses and commissions and stuff?
Commissions and overtime, yeah. So variable income, they shade. So that shading will mean that multiple is, 6. In terms of the increase. So that's increases. And the general figure that you want to know, if you want to just do a real back of the envelope calculation on your own borrowing power, you can borrow roughly around 5 times your income level at the moment. For couples, it's a little bit above that. And for singles, it's a little bit below that. So that's the current lending landscape.
It used to be a little bit higher, but I suppose interest rates and everything that's happening in the markets.
Yeah, used to be 8.
Yeah, literally. Okay, perfect. So if you're looking to if you can increase your income, second job, bonuses, that kind of stuff, $10,000 increase can have up to 7.5 times loading in terms of borrowing capacity, what you're able to borrow more.
Yes.
If it's a bonus or if it's commission, it's shaved down to closer to 80% of that amount. So then you're down to maybe times it by 6. That's cool. What about if I'm looking at my debt, if I'm looking at what's coming out, what I'm spending, I'm well above the HEM.
The HEM.
So if I'm well above that HEM and I'm looking at my expenses, some of the things that have bigger reductions on borrowing capacity that people don't know about. For example, HECS.
Yes.
Talk to me about it.
HECS has a big impact on your borrowing capacity. So the way lenders calculate, the way you actually pay your help debt repayment is a percentage of your income. So even if you have, it's got nothing to do with the amount that you owe, which is very different to all debts. Like when you owe monies to someone, they kind of work out an amortization schedule and you just repay that over a period of time. With HECS debt, it's got nothing to do with that. They just take a percentage of how much money you earn. So, if you earn 150K, they'll take, 8 to 10% of that income and take that away. So HECS debt help debt can have a really big impact on your borrowing power, particularly as your income rises. And the actual impact it has on your borrowing power is going to be all tied to your income level. To help, if someone wants to work this out really quickly and they've got a help debt, like a really quick way of working it out that I use is work out your yearly help debt repayment. So jump on the ATO website, work out what income you have, the percentage band you pay, multiply the two together. So, you're on 150K, you pay 10% of your income. That's $15,000 a year that you pay in help debt repayment. So if you pay $15,000 a year, you want to know the impact on your borrowing power, multiply that by roughly 10.
Really?
Roughly 10. Okay. And that's the impact on your owner-occupier borrowing power to buy a home.
What about investment? Does it change?
It does, because there's a lot of variables that go into an investment calculation, particularly around how much of a deposit you have, the yield that investment will generate, the type of expense that investment will have. So it's hard to give a real ballpark number for investments because every investment is different. But for owner-occupier, it's a little bit simpler, and the simplest way of thinking about it is multiply your yearly expense by 10 and you'll get your
that's like if you're earning 100K, 7%, $7,000, times that by 10, $70,000 that you can just pull out of thin air.
And imagine you have a $5,000 help debt or $7,000 help debt. Like, you're going to pay it off next tax year anyway, and it's a debt that you're accruing interest on and paying CPI level inflation on, which has been high. So
I felt that pain this year, man. I felt that pain this year. I got a little bit to go, so I'm going to pay it off this year. But I couldn't get it off before the end of financial year, and I copped that little.
Yeah, so it's a good thing to pay off. People have previously and historically thought of help debt as like good debt, but
no. Looking at the camera, I'm saying no, definitely not.
So removing it can really help. improve your borrowing power. That's a good one.
And I think another thing to add on as well that some people get confused about. Say for example, I'm on $100,000 to keep it all figures even. If I've got $7,000 left, or if I've got $70,000 left, is there a difference in terms of change in the borrowing capacity?
No. Exactly the same.
It's going to be still 7,000 times 10 for that example we used earlier.
Yeah.
Massive one. I think a lot of people don't take that into consideration and think they've got a little bit left. Oh, it won't help too much, but it's still the same.
We had a really funny situation where we had a really high income lawyer client, single fella, and he had a small help debt. Like it wasn't that small, but it was about 30K. But he was making, over $500,000 a year. So doing really, really well for himself. And the impact of his help debt on his borrowing power was about 4 times the actual help debt size. It was like, so it was like huge to his borrowing power impact. So that was like a funny little situation. When he got his 2 different borrowing powers, it's just like, bro, if I close my help debt out, I pay $30,000, I can borrow an extra, $300,000. What's going on here? It doesn't make sense. Yeah. And then I have to explain this to him, and it's like, okay, cool. Well, I'm happy to pay it out. I can buy for a much higher budget as a result. So it can really impact your borrowing power. It's all tied to income.
Good. I'm glad we covered that, because I know that for the majority of us, we all have HECS debt or something we're tidying up, and there's always these misconceptions and stuff like that. So I'm glad we covered that. What about, I've got down here, credit cards.
Yes.
Now, if I've got a credit card with a $50K limit, bit of a spender, but I come to you for a loan, I say, Redom, I'm really well behaved. I've got a $50K credit card, but I've got no money owing on it. I've paid it all back. I'm really, really good. I'm really well behaved. What would you say to someone like me that's being that silly?
Close it.
Close it?
Yeah. That's as simple as it gets. It has a $200,000 to $250,000 impact on your borrowing power. So credit cards have an impact on your borrowing power by roughly 4.5 to 5 times the limit. So if you want the math behind that, like a credit card limit, multiply it by 3%. So $10,000. If you multiply $10,000 credit limit by 3%, you get $300 as your monthly expense that they put into a calculator.
Wow.
You multiply that. I like to use yearly numbers to make these numbers really calculated. So 300 multiplied by 12 to turn it into a yearly expense figure. It's $3,600 in yearly expenses just from having this credit card, even though you have no expenses anyway. But that's what the banks will do. They'll include, you spend 3.6K every year on paying for this credit card. And now that's where you multiply that number, that yearly expense number. You multiply that by 10, and you're getting to 36K. So it's a little bit less than the $45,000 to $50,000 multiple that we have there, but the ballpark multiple that you have is around that $45,000 to $50,000 multiple. Some lenders a little bit less, some lenders a little bit more.
So times the credit card amount by 4 to 5 times.
Yep, 4.5 to 5.
4.5 to 5.
Yep, and you'll get your that's an easy one to calculate. Just multiply it by that.
Well, if you're watching this and you've got a credit card and you think you're good, or you think that you need it and you're trying to buy a house, close it.
Close it and reopen it.
Close it. Literally, close it, reopen it, done.
Yeah.
Easy as.
Get rid of all the direct debits you don't use anymore.
Tell me about it. All right. What about, is that the same for small loans, personal loans? I've got a mate on here that we're helping through pay off some debts. Good old Lockie, shout out if you're listening. He had a number of personal loans, just from his circumstances and his past life that he's paying for now. But what about like a personal loan with a bank in terms of waiting and stuff? Say I've got a $20,000 personal loan with CommBank or something like that. What's going to be the multiplication? Is there a multiplication factor on personal loans?
It's trickier to do, so that's harder to give you a really quick general ballpark on that. So if you wanted one, you could work out the yearly payment, multiply it by 10.
Wow,
that's probably a really simple guide that you can use if you want a back of the envelope one. But personal loans are different because of the term that you have on them. So some personal loans are paid off in a year, some are over 7 years, some are over 10 years.
Okay.
Also, one thing that Lockie your friend's name?
Yeah.
Yep. So one thing that Lockie, if he does own any other property, there is the potential to do what's called a debt consolidation loan. So that's where he adds the personal loans onto his home loan itself. So that a home loan, to borrow to a home loan level, they'll assess you much more freely than a personal loan. So you open up your borrowing capacity doing this. If he does have equity in any of his properties, or if he's a homeowner who's got any equity, he can do what's called a debt consolidation loan.
Okay, so he doesn't own any property yet, and the good news is that he's paid off. He had 3. I think he had 5. He's paid off probably 4 of them. He's down to his last one. If I'm going to do that, I'm just thinking through that. If I'm going to then consolidate with my home loan, I'm going to pay a little bit more because I'm then paying interest on that loan amount for, say, 20, 30 years. Would that be correct?
Yes, you can have a higher interest cost over time if you did do that. You'll have a lower interest rate generally, and you can control your repayment. So you can split that debt consolidation out into a separate loan split and be like, look, it's got a lower repayment, lower interest rate, but I'm going to aggressively pay this bit off first.
Yeah, okay, perfect.
So you can choose to do this. And a little shout out to Lockie. My own story started not too far from that. When you lose your home, you got to make it work. And I was a teenager starting out. My first couple years of earning money was trying to help my family at that time, and did incur a little bit of debt. That was my starting point in 19, 20, and a lot of young kids, a lot of young boys and girls out there in that situation, that's their starting point. They just move out of home. Life's expensive, income's not that high. It can be tricky, but if you understand this sort of stuff, focus on property and understand the benefits of time and capital growth, and you get yourself into the market somehow, you make those tough choices that Lockie's making to do well for himself. It does compound over time, and it does really help you. And I'm 33 now. I look back on the choices I made a decade ago to fix my finances up at the time, and these things are accumulate
compound
to this
interest
sort of situation. It can, so it's a starting point. You got to put in the hard yards, and you got to make these tough choices sometimes to make it work. And it sounds like Lockie's doing that. So
100%. I think it took him, I think it was 3 years he had those loans for. I've been working with him on he sends me payments regularly I hold the money in an account so he can't spend it. And he's reduced in probably 4 months 3, 4, 5 of those debts. So he's almost back on track. But
what a good friend, Lockie.
We'll take him along on the journey. Hopefully he can purchase a property and we can, share it on the podcast. Okay, look, we covered salary increase. We covered credit cards and small loans, HECS. Car loans, is that going to be the same as well?
Yep. That's exactly the same as personal loans.
It's going to depend on the loan terms, but times it by 10, you reckon? For a car loan?
The yearly repayment.
Times the yearly repayment by 10, not the car loan amount, because I was going to say.
I
see a lot of 19, 20-year-olds run out and get a brand new shiny Ute or a brand new Merc or, all those sorts of cars. And I just think you definitely didn't think this one through past impressing your mates. You know what I mean?
Yeah, exactly. Yeah. That's common. That's a trap that we find ourselves into. So to a younger audience, don't get a car loan to go fund your first car. I drove a really, really crap car to begin with.
What were you driving back in?
Me and my wife, we've been together since I was 17 or 18. So she's been through the full journey.
Met her first day of uni.
Met her first day of uni. You know this.
Yeah.
We were practicing handshakes, actually. That was my first day of uni.
Wow.
I went to I did a course that was just freaking Donald Trump invented the course or something. It was like The Apprentice, where you actually learn to shake hands. And that was one of the first things I did. And she's been through the journey. And, that was our first car. It was horrible.
Have you upgraded now? Since you got a family?
Yeah, quite a few times.
Okay, perfect. Perfect. All right.
It's fun going through this journey together, though.
Yeah, definitely. Especially if you've been together since you're 17. It's
it's crazy, right?
Yeah, 10, 15 years ago. Okay, anything else in terms of other ways to increase your borrowing capacity? We talked about eliminating HECS, and we talked about credit cards, small loans, car loans, salary increases, second or third job. What about PPR versus renting? Now, if I buy my PPR, say I've got $1 million of debt or $1 million loan attached to that, does that, as a PPR, have an extra weighting when the bank looks at my borrowing capacity for, say, an investment after that?
It does, yes. So I can't give you those numbers off the top of my head.
Yeah, of course.
That one's really tricky to do. You need Excel for that one. But when you rent, they take the actual rental expense that you pay. That's it. They don't load it or anything like that. So if you pay $500 a week, they'll add $500 a week directly into that calculator. When you have a mortgage, all mortgage debts are assessed at much higher than the actual repayment you pay. So if you're paying a 6% P&I interest rate over 30 years, the bank will use a 9% P&I interest rate under the lending calculator. So mortgage debt is buffered while renting isn't, so it can boost your borrowing power by taking advantage of that.
Okay, so if you've got your PPR, they put an extra, is it still 3%, the buffer that they put on that mortgage?
Yes.
Okay. And
by and large, yes. There are differences.
Here's a question for you. If I'm renting and I'm subleasing a room out, right? So say $1,000 a week I'm renting. I rent a room out for $300 a week. When the bank's calculating, because my name's on the lease, are they going to take the $1,000 or the $700 that I pay?
It's a good question. Officially, but policy-wise, I'll take the $1,000. Most banks will take the $1,000. But if you can explain it, particularly if it's your partner, that's...
No, but if I'm subleasing it to a total stranger, I can show the bank that they're paying $300 a week and have been.
Yeah, that's tricky to prove. And, you're going to be asking for a policy exception from a bank for that. Some banks under, exceptions will allow that, but you don't want to be putting yourself, as an investor, you don't want to be putting yourself in situations where you need things from the bank. You want to make yourself as favorable as possible to as many banks as possible. It opens up your lending options, and it's part of good financing strategy is having options. That's a really key part to it as well. Can I touch on one?
Yeah, go, please.
Okay. There's this big one out. This is where finance strategy can help you boost your borrowing power. So these are all things you could do that we've talked about. Increase your income, cut your expenses. There's a few variables that we talked about here. But that's what you can do. But there's some things that I can do and mortgage brokers can do as well.
Here we go. Yeah, hit us with that.
There's a few different strategies, but one strategy that we're talking a lot about at the moment is how to boost your borrowing power by 20% at the moment for any purchaser in Australia. Upgraders, first-home buyers, property investors. There's a way to do it. You're going to hear it here first because no one else is talking about this yet.
Podcast exclusive. Hang on.
Podcast exclusive.
Yeah.
What you can do is there is a new 1% refinance buffer policy to help people who are stuck from higher interest rates refinance. Banks are now allowed to use a 1% refinance buffer. So instead of assessing you at 9, they're assessing you at 7. So, if you pay 6%, they're currently assessing you at 9%, but now they're assessing you at 7 for refinances only, which begs the question, how can you use this to actually buy a property? They're still assessing you at 9 to buy, but there are differences in the lending market where you can borrow an extra 20% by going to a non-bank first who gives you a lot more money. There's non-banks out there that offer, between 15% improvements to your borrowing power for first-home buyers and all the way up to 50, 100% increases to property investors who already have existing mortgage debt. So you can go to a non-bank first and boost your borrowing power.
Yep.
Now, that has downsides that a lot of people don't like going through because, how long do you want to be with a non-bank and what interest rates will they start charging you after a few years? It's a bit scary being in this land of, I'm out here in the borrowing capacity spectrum where only 1 or 2 banks lend to me. But you can get your money there initially and then after 12 months, refinance back to a mainstream lender using that 1% buffer rate rather than the 3% buffer rate because they'll allow for refinances after 12 months. So,
interesting.
Does that make sense?
Yeah. So I might have to go to a second, third tier lender because I can get the more money and then I can just refinance after
12 months.
12 months.
Yes. So you can use this
very
refinance
sneaky
tool, this refinance policy, and there's a range of lenders offering it now. There's like, half dozen, all the big groups, and within 6 months, I think it'll be everyone. There's a whole range of lenders that you can do this with, and it works. A question everyone has that we speak to is, does this 1% buffer even work? Because all the lenders are couching it as like some sort of policy exception. It works. We've done like 24 of them already. We've been refinancing a lot of property investors at the moment who are stuck on higher interest rate terms with non-banks. There's a lot of property investors out there who went and built their portfolios over the last few years. We've been managing to refinance a lot of them. Not everyone, because they can't make it work, but a lot of them now meet the benchmarks to be able to refinance with this big policy change. So the step 2 to this equation, refinance back, it works. Like we have solid proof that it works. We've done it with multiple lenders now.
They don't lock you in for like 3, 4, 5 years or anything?
No. I mean, a lot of mortgage brokers won't like to do this because I'm telling people to refinance after 12 months. So, But it's not about mortgage brokers here. It's about borrowers and achieving what they actually want. And if you want to go buy another investment property, you're blocked off. Explore this channel. Speak to your person and explore this channel. Tell them about this strategy and be like, what if I did this? Can I make my purchase work? And the questions you should be asking yourself if you go and execute this strategy is you want to make sure you can refinance back, right? So, don't go taking on all this money from a non-bank without working out what the
9% or something.
Exactly. So, work out whether you can refinance back. So ask those questions up front, being like, what's my borrowing power at the moment with these mainstreams? What's my borrowing power with these non-banks? And what's my borrowing power when I refinance back after 12 months? If you have income rises, plug that in because it's 12 months later. Have answers to your 3 questions. And if your loan size is going to be comfortably within this refinance at 1%, then, you might be good to go to execute this strategy. We did one yesterday as well for a purchase who was entering a bidding war for their own occupier purchase. It was in Inner West. Beautiful, beautiful house, wonderful clients. They've been trying to buy for a long time, and borrowing power reductions have smashed them, and property prices haven't fallen in the Inner West at all for this borrower. And we've been able to get them to purchase. We got them an extra $300,000 in borrowing power. And the way we did it was by talking them through this strategy. We crafted it yesterday for them. They went and bought last night. They had to pay $200,000 more than the other bidder than they wanted to, but they got their dream home. And the only way they did this is because they were able to access more money, and they have a plan to exit back within 12 months. So it's pretty cool.
That's great. That's a podcast first, and I'm sure that's going to be very valuable to a lot of people that are, in and at the top of their range. Now, that's fantastic. I was going to ask you for your golden nugget, one piece of information shared with the audience. I think you've just revealed it. So I really appreciate that. Is there any final words? I think we've covered a lot today in terms of HECS, credit cards, small loans, how these are actually affecting you, how an increase in salary can help you, and maybe just a little golden nugget in there if you're struggling and can maybe, you need an extra couple of $100,000 on your borrowing capacities.
Yes. One little thing that I can pass on is the magic of the number 125. That's the number I use to really work out. When someone asks me, hey, what if I did this? What about this change? Yep. Right? I get the monthly expense of that change. Pretty easy to do. Like, get a credit card, monthly expense, I can work that out, on top of my head. Multiply by 125. That is just a real quick little snapshot. If you ever want to work out what's going to happen to you, you want to calculate a change to your borrowing power, really quick level, work out the expense level that you have, multiply by 125, your monthly expense by 125, and you get ballpark that number as to what it's going to be. Little variances within that, but that's a magic sort of number you can use, property investors, home buyers, if you really want something.
Full of value. Redom, I appreciate you coming out. I appreciate you jumping on, and I'm hoping that everyone that's listening to this has got a better understanding of how they can increase their borrowing capacity. Thanks for coming out and jumping on the Everything Property podcast.
My pleasure, David.